Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're going to be going over the opening range initial balance on the end-of-day charts and how that can play an important role for giving traders market-generated information at the beginning of each month, but also at the beginning of each week, and how you can potentially use that information with your trading. I'm just going back and this is a concept that Toby Crable talked about in his day trading opening range breakouts. Stottlemyre, Dalton, and Mind Over Markets and Market Profile, they use the initial balance as a method of gauging the type of day potentially that was going to present. Now, as end of day traders, we can also look at this information and use it to our advantage, looking at potentially either continuations of trades. So we talk about the market does one of three things. It's trying to break out, fill more orders, and continue. It's trying to, it'll break out, create a false break, and then reverse and go to the other side of the range. Or it will break out of a trading range, pull back inside, and then just go into a trading range again. But when we look at the opening range, if we consider Monday as the opening range and Monday, Tuesday as the initial balance, in some cases, depending on how the previous week sets up, we want to start to look at Mondays. Now again, on this chart, the black dotted line is the first day of the trading month, and then the lighter gray dotted lines are Mondays. So if we just go and we look at each Monday, Tuesday, we've talked about this in other videos, roughly 80% of the time, the Monday or Tuesday will potentially act as a buying high or a selling low. A selling high or a buying low for the week, and not in all cases, and we'll get to that in a second. But we look at how that can give traders an idea, potentially how to place themselves in the direction of future momentum for that week. So we're looking at the pound yen here, and if we look at Mondays, and one of the things that I look at there's two things that I look at with Monday, is when it opens up, does it open up inside of the previous week's range? Now, one of the things that, if you know much about Market Profile, we'll talk about how price will often auction in the course of a week, roughly, and form a distribution curve. So this middle area where the bulk of trading will occur, they'll call the value area, and the main area where most of that volume occurs is what they call the point of control. But the market is constantly trying to either auction back and forth, as we see in a normal, what Dalton called a normal trading day or a normal trading week. And then we see other types of patterns where the market may have an opening drive and then potentially auction back and forth for the remainder of the day or the week and form a different type of distribution pattern for that day or that week. Or we may also find that the market may potentially try to break out and reverse and then continue to auction and fill more orders and move in a downward direction or an upward direction. But when we look at Mondays, one of the things when we relate it to the previous week is where did Monday open up in relation to the previous week? So in this particular case, we can see that there was a trading range that had been established. The market broke out, it pulled back, and the bottom of that range, where there had been a range extension in the previous week, when the market opened up on the Monday, it looked bullish. But if we relate it back to that previous week's Thursday low, there we can see there's a point of control, and this is where the market psychology comes into play. And you've got to start to look at the previous week's price action and understand potentially, as this market auctioned back and forth, again we can see that this is what Dalton would call an open auction, because it traded back and forth, as opposed to the next week where we had an open test drive rejection, and then the market continued to auction south. But again, looking at Monday in relation to the previous week. So in this particular case, we have a market that on the Monday went out of balance from the previous week's range and continued to form a range extension, pulled back, was unable to go lower. Now this is again an example of where amateur traders or the market in general will get caught off guard, because if you were short this market, your stop most likely would be there. And this is where you have to start looking at who's potentially going to be trapped into the market. So, not saying that you may have positioned yourself for a long there, but traders have positioned themselves for longs there. The market is broken out. It's pulled back into the demand area again on the following Monday. So we have a market that's gone out of balance. The Monday opens in range, but out of the value area. It tries to retest that, pulls back in. Now, and another concept that we talk about with this is 50% levels. So again, if we look at a range that's established, I'll put the Fibonacci on here. We want to look at potentially where the 50% level is, because if the market's roughly, the 50% level is roughly here. If the market, if breakout traders were to position themselves on the break of that Friday's high on the following Monday, again, the market, if we were following that bell curve distribution, it's going to try and auction back to the top of that distribution and potentially either fail and fill more orders and come back in, or it's going to break out and explode. And so again, we see that P-type distribution pattern as the market over the course of that week exploded upwards. And then again, we see the market on the Monday open in range, break out of value, retest, continue up. Weekly, bears came in weekly, but then bulls were weak as well. We saw a bearish pullback into that market. So just coming back to our original topic, what we want to be looking at with this is, if we go to the pound, we'll demonstrate this on the pound. So if we go to the pound again, just go through your charts and mark off your Monday range, Monday, Tuesday range. So in this particular case, we see the Tuesday went higher, so it potentially may have looked like a pin bar to traders, but what you want to be thinking is that this market actually made a higher high in that initial bounce. So the market is actually finding new buyers as it goes higher. Now again, it's pushing higher, but it's not one of the questions they'll ask you in the market profile each day when you do your workup is how well is the market doing in the direction that it's trying to go. So we see a market it's potentially going up, it's pulled back, it's tried to go out again, it's gone out of balance, it's pulled back on the Thursday, and again, just thinking counterintuitive, these are where limit order traders will position themselves. So they see the market going up, it's not doing a great job of it, but they will follow that market up with limit orders because they know that potentially if that market's going to fail and then go to the other side of the profile. So we talked about going and retesting. So we see a point of control here where the bear candle is. We have a market that over 2 weeks now, and again, this is something else you'll see is 2-week patterns. 1-week patterns tend to be trending markets. But you want to start to draw these opening ranges. So we see a market that's very bullish, and then we see a bearish Monday. It's opened in range, it's broken out, then it's pulled back, and again, limit order traders will either place a breakout order underneath the bull candle. So again, bulls place their stops into this market. So we see breakout traders may have entered the market here as the market's broken out and closed for that session on the Friday morning. They move their stop either to break even or below that day that they entered the trade in. So there's more orders that will get filled not only on breakout traders, but now the stop losses are hit. That market then auctioned down. We see Monday open up, retest the breakout gap, followed through again, breakout. We have our opening range, initial balance on the previous week. This market came back on the Wednesday with a bull candle. Now again, 50% of that range. This market has closed above 50% of that range. You are either, if you were to trade that as a breakout trader, again, there's your 1-bar stop, or you're in a market and there's your defined risk. But you want to start to look at these opening ranges. Now the next part of that is looking at the beginning of the month. The next part of this is even looking at the beginning of the month. So if we look at, there's a hypothesis that 80% of the time within the first 2 candles or initial balance of the markets, the Monday, Tuesday, or the first 2 days of the trading month, potentially we may have a buy or sell level at least for one impulse move. So we look at this now. Again, we talk about a market. Is it opening within a previous week or month's range? So in this particular case, we see the market open up in June, but it's opened up inside of May's range. Even though May's had a bearish breakout, this is still within the range of May. The market tried to go higher. It broke out on this big bear candle breakout. It pulled back. It filled more orders. And then it made a second attempt to drive back down, at which point the market drove back up. So again, we have our first 2 days of the month were within the range, so then we would look at the previous range. And again, if we were to draw a 50% level of that range, you can see the market retested 3/4 of the range. It broke out at the 50% level to retest the previous month's lows. But again, just looking at Monday, Tuesdays, we can see here Monday was the low for the week. Then the following week came, and we see Monday, Tuesday. Tuesday acted as a buying low for the week. So even though we see a range extension here, buyers came in and were the dominant force over the rest of that week. Again, we see a bearish pullback, which is, again, if we look at our 50% level for that week, you can see the market cross that. Gave a bearish candle on the Monday, which would have sucked early bears into that market, think it was going to drive it down again. And we see that market explode. We know that there's breakout traders on the high of Monday that would have taken a 1-bar stop on that trade. The market then proceeded to come up, and we see our Monday, Tuesday range. It pulled back within 50% of that opening balance and then drove back down again. So these are little things, traders. Look at the opening range, the initial balance, the Monday, Tuesday. Very important. Again, we'll look at the yen. So we see a breakout and a pullback. So when you see something like this, now understand, anything that's taken within this range is still defined by that risk. It doesn't matter where you get filled. But one of the things you want to consider with all of this is that when you see a tail come down here, and if we were to call that the point of control or the middle of the range, so again talking about our bell curve distribution that we talked about, the market was unable to get past that middle point of control. So when we see this market breakout on the Friday, it's broken out of that range. It does probably a just get this out of here, a full extension of that range up, which it did. 1.5 of the large candle. Yep. And then it gave a signal bar. Now, a signal bar obviously is something that we see this reversal candle set up. So you've got market enters that were market entry order traders that would have entered in here. We've got breakout traders that would have entered in here. And the first place they will try and target is the other side of that impulse breakout on the previous week's Monday. So again, we have a Monday that opened below the point of control. So remember the previous week we talked about the point of control. It's opened within range, but still it was out of balance on the Friday. It came back into balance. But bulls, breakout bulls would have had their stops below Monday's low. And again, now we're back into the previous week's range. So Monday, Tuesday, initial balance. Look to study these traders. It can give you a lot of great clues. So again, here's an example of a Monday opening up within the previous week's range. So again, we've got our low and our high support and resistance levels. When we see it open up within range, we want to use the previous week's range. Now again, we know there's stops above the big bear candle up here. We know there's stops above the big bear candle up here. And those stops can sometimes not only trigger stop loss, but new entry orders as well. So Monday, Tuesdays, study those. Look for, if you want to combine that with any other indicators you're using, but it can be a powerful bit of information, especially at the beginning of the month. We talk, again, remember 80% of the time that first 2 bars of the month can potentially act as a buy or a sell level for the month, or at least half of the month, for traders to potentially trap some more profits off of good momentum trades. So hopefully you got some value out of today's video, traders. Initial balance, opening range, study these concepts. I think it's really powerful for end-of-day traders, especially at the beginning of the month and on the Monday, Tuesday setups. So stay disciplined, traders, stay focused, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.